Welcome to my first video in 2023. I wish you a happy new year and all the success and great health, great friendships, lots of good things happening in 2023. 2022 was quite challenging, so I thank you for your support to everyone following this channel. And so I thought let's start off this video with after the break with a more macro view. So talking a little bit where we are standing heading into the year for Chinese stocks and some of the bigger issues around quite recently. My main message going into this year would be that China has massively de-risked by now. China has always been a very risky investment, but remember what happened last year with all of those macro issues around Chinese economy, geopolitics, around the US-China relations mainly, but also some incidents around the Pelosi visit to Taiwan, zero COVID, lots of things have happened where it was quite challenging for investors to really, stay strong and keep on being invested in China, right? But just very recently, in the last couple of days and weeks, we have actually very positive developments out of China. The first one actually around the delisting issue, which I've covered here on the channel, that the PCAOB came to the conclusion that they have full access to the auditors' work that are auditing Chinese companies. And so the delisting issue right now should actually be kind of off the table. Of course, there could always be a flare-up in terms of what happens if at some point in the future the Chinese side wouldn't be compliant anymore. But for now, they're fully compliant. This is a very positive development. It's also showing that China, in this case, really played by the rules. Although, of course, this is a political joker card to be played by the US, and there could be hiccups now and then. But China was fully compliant and also made clear that they want to adhere to those international rules, and that is quite positive. Also, since they always kept on saying that they're going to do that, and in fact, that's exactly what they have done. This should instill confidence and new trust, which I think is highly necessary. Then China is opening up again. This is the biggest news. How many people and folks have said, zero COVID is going to stay forever. China is shutting itself down, maybe with some dark intentions going forward. But now quite the opposite is true. And as I have outlined in previous videos, actually the protests, really accelerated and have been a catalyst to the opening up because it kind of gave the government also the argument, and they were able to give the responsibility actually to the protests and the people that they actually want an opening up. And that's what happened. Latest news is by the 8th of January, we'll have free entry to China, and people who want to travel from China outside to wherever they want to go can do that as well. So this, in my point of view, is the biggest de-risk topic or argument ever, because this will ultimately help a lot. I always mentioned here on the channel that I think, when China is open, then people can go there and see with their own eyes what are the circumstances. People cannot only read it in the media and have those negative takes. And I think, frankly, this will also rebuild relations in the business area, in the politics area. And so this is very, very positive, because this will actually instill lots of trust again, and it's a very, very necessary step. And I think maybe some more of a vague factor here, but I think, in my point of view, the biggest argument why a de-risking of Chinese investments is taking place. And of course, there have been many question marks around what an opening up means. We might have those COVID waves that are certainly impacting people's lives, and they have with Beijing being hit first, but has peaked also already, and other cities following. So we can expect that most of the country should have experienced this first wave by mid-January or towards the end of January, but most of the bigger cities already have experienced most of it. And for example, here on New Year's Eve, we've seen really large gatherings outside for quite a couple of days, there has been very low traffic. You could see that on subway traffic, but also generally from footage from on the ground, that people really wanted to stay home, but they changed after the sickness passed. Quickly, there was a take-up in, for example, restaurant visits, and in this case here, New Year celebrations, also in mass gatherings. And that's shown how quickly actually this pivot is happening. And so, this also kind of tamed a little bit the fear around, what is happening in case of an opening of China. Yes, of course, there will be disruptions along the way, I would say, actually also for work and, supply chains, logistics. They are certainly impacted by those COVID waves. But I think all of those worst case scenarios actually were not true. China will manage this, and it seems like this opening up is happening very, very quickly now, with the 8th of January being actually even the deadline. And I'm personally looking also very much forward for free travel between, for example, Germany and China again, which is awesome. Now, of course, not everything is great, so there are still risks. For example, the US sanctions bans, right? There is still a bad relationship between the US and China. And one example would be what we've talked through here on the channel, the chips bans that have affected Chinese tech stocks, certainly, but where we also already heard in some of those earnings calls that actually they don't really impact the day-to-day business too much. And in the long term, China will become more self-reliant and actually trying to come up with their own technology, which we just had breaking news. Huawei is to launch 12 nanometer and 14 nanometer chips in 2023. We have more news around patents, different technologies. So this is too early to say whether or not this will be a sustainable solution here. And we can expect that China needs more time to catch up with the latest technology that is only available in the West. However, clearly things are happening on the ground here. So we could actually say that those sanctions have never really held back China. And in the end, going forward, it should be really hard actually to, kind of limit what China can ultimately do in the technology sector. That's at least my views, and we see the first signs here. So keep in mind, it's not fully risk-free to invest in Chinese stocks, obviously, but both on the regulatory side as well as on the fundamentals, regarding here the China's open up and so on, it's looking much better than last year. Here's some more examples. Who would have thought that China would abandon the QR and health code systems that will, for example, that have been used for population management in terms of, can you enter a mall or a restaurant or not? You need to have a daily active health code with a PCR test. Now, all of this is abandoned. They even went so far and deleted the data, which I think is also a major underreported thing, that China is really scrapping all of this, which of course has some, let's say, dystopian and surveillance functions there also. And the fact that they get rid of that is, I think, a very bright sign, because of course always technology can also be, let's say, used in a bad way, or if the power at least is in the wrong hands, then things can go bad, right? Now, another topic here is also around the housing market, which is of concern to lots of investors. But we have seen declines in asset prices around the world. So also the Chinese housing market is no exception for that. And so far, also most of the worst case scenarios about a domino effect in the housing markets in China have not really come to light. And instead, now China is also on this side doing a pivot. And for example, here China central bankers and banking regulators allowing to lower interest rates. And also there have been even more reports around that the government is, easing a little bit on tightly regulations that they have introduced before in the housing sector, trying to boost this sector again, similarly to the internet company sector, which has always been described under this famous technology crackdown, which is now easing up as well. And one example would be that foreign games have been approved and got licenses again in China. I mentioned that one in my Patreon community, that, for example, like stocks like Tencent, NetEase, Huya, Bilibili, Douyu, and so on, they are profiting from this fact because those games haven't been approved like for a 2-year period. And of course, China have had their own reasons for that, which we've previously discussed on this channel. And so this is just one of the signs is showing a lot of easing up here, because China needs this tech sector in order to pivot around the economy, right? Now, what does this mean going forward? That China is opening up. Of course, there have been, once again, many concerns and bad stories around that, an opening up could actually be very bad for the economy again, because everyone's getting COVID. And we've discussed the housing sector here before as well. However, what is, I think, under discussed here is that there is lots of pent-up demand and also lots of record savings. So here you see this blue line is actually 2022. So the net household deposits, which are the household deposits minus household loans, has gone up sharply, as you can see, in contrast to the previous years. And that means that Chinese consumers have been saving during those uncertain times, and they will, of course, start consuming again when everything has opened up, as I've just described it. And the question is just where they're going to spend it. So, of course, we could assume that one big chunk of it will be going into travel, right? Overseas, but also domestically, but certainly they will also invest in or buy other topics. And that's, I think, what has led to some of those latest rallies in Chinese technology stocks like Alibaba and so on. Many of these stocks are now trading above their 200 moving average, which is a great sign to see. It's been back tested. Of course, it can always go back to this. But so far, Hong Kong Stock Index and also like KWEB, these Chinese internet ETFs have been doing quite well and shown a remarkable recovery there. And I think, one of the reasons is that we should now see a similar effect that we've seen in the West, that these excess savings will trickle again into the economy along with subsidies and stimulus, and therefore we can expect, for example, earnings to grow. However, I should say that I think that China has also closely watched what happened in the West, and I do think there won't be any, like free money, and also if the revenge spending is getting too hot, I think there will also be some brakes applied there, because China is always about harmony, and social unrest is a no-go. And in case that inflation would be spiking too harsh, I think that would be an issue for the government, which they would really avoid in the first place. And I think that's what is going to happen here as well. So expect that there is pent-up demand, and that this could actually even outweigh something like, for example, those negative effects of the housing market, which should now hopefully stabilize given all of those positive news that that we've seen coming out. But this is also something we're critically thinking. You don't really sell your house in order to buy a new car. This is also not the way the Chinese consumer works. I think the Chinese consumer is heavily working with those cash flows generated by employment, of course, or their own business, and then those excess savings that are being used, and not so much about a financialized economy that's relying on debt, let's say, to purchase new products. Usually Chinese consumers really like to pay in cash. And so while the housing market is down, and that might be depressing a little bit on the sentiment, I think what is rather happening here, looking also at another fear factor here regarding China, usually is demographics, right? So China has an aging population. There are not enough kids to sustain actually even a population growth. But if you look here, what's interesting here is the 30 to 35 years old and the 35 years to 40 years old. These are a large chunk here where you can see That's making up to 4% here of the population, and they are now in an age where they are maturing with their first job or even getting promoted, so having a nice income, and they are now starting to buy houses, buy their first cars, buying a fridge and all of this stuff. So this will be a period that they are entering where the consumption is being upgraded, and this is a larger chunk of the population going in there. And I previously pointed out, for example, with NIO's interior car design, I think they are really catering exactly to this type of population and demographics there, with this fresh design, neatly designed for a younger population, for a female population too. So really addressing those young professionals there, and this should actually also in the short term overweigh and also be a more positive aspect than the whole demographics in which are in the long run a bit more pessimistic for sure. So you will hear all of those issues around India overtaking China in population and so on. However, I think what's also going forward is that China will be investing heavily into technology like automatization and so on, and upgrading their workforce with, for example, artificial intelligence and some sort of tools that are helping productivity in China, as the Chinese society in general is maturing and entering let's say a more sophisticated period. It's not the old China anymore. It's not the workbench of the world anymore. And so I'm not too pessimistic on this topic here either. Where there is a lot of concern right now is, for example, in the automotive sector. So expect that Q1 and Q2 will be sluggish. This might be partly to demand, like still the woes around people not wanting to go out, not wanting to spend immediately in a big manner. But of course, with the opening up this and the excess savings that I've just pointed out, this is just a matter of time until this should pick up again. And also, as I always point out in my NIO and Tesla and so on videos, that Q1 and Q2 is just a cyclical downturn in the automotive sector in general. And what comes on top of that is global recession ? There are concerns right now around, of course, those large interest rate increases in the US, and so maybe a cooling down of such big tickets purchases. So that is, I think, what has mainly weighed also on Tesla's recent sell-off, and in general, for example, also the Chinese EVs not doing as well, or automotive in general, also BYD and Volkswagen are all not doing as well on the charts, despite those China opening up stories. So in comparison, it's maybe that investors are prioritizing other growth opportunities for now. But that's going to change again, Q3, Q4, and so on, and going forward, coming out of this recession, if there actually is one, and depending on the Fed interest rates as well. Now, let me close this up by some more macro picture and outline here again. I've actually found this one on a blog, which the topic was around how are venture capital investors aligning their investments right now between the US and China. And so, of course, venture capital is the earlier stages of investments before companies are actually going public. So this tells you where the future is actually heading. And this is already a little bit of an older chart, but basically the author said, like, he's seeing those investment trends in the US more focused on, let's say, like finance, services, software as a service, and so on. So more on this, let's say, more artificial, financialized topics there. The metaverse, although there's big question marks around this right now, as well as NFTs, right? I'm not a big fan, never was, of NFTs. Web3, where is crypto heading? Still no breakthrough in that regard, and certainly now also a lower sentiment towards those three crypto-connected industries, I would say. And then Interestingly here, synthetic biology and AI pharmacy. So this is about drug discovery using AI to come up with new drugs, and also new technologies like CRISPR or Cas9, those type of gene editing tools. That's also, I think, not ripe yet for investment, as we can see, for example, in Cathy Wood's ARK funds. But major focus here for some of the US venture capital investors. And then retail, that's just e-commerce and creator economy. In contrast now to China, where everything is kind of centered around new energy. And that's, of course, batteries, that is EVs. This is decarbonizing, so carbon neutrality goals. This is where China has invested strategically already 10 years ago. It's a big topic still. And in general, we have the bigger trend, like in China manufacturing 2025 and the government plans, that they are really focusing more on what they call the real economy. So more hardware related, let's say chips, industrial robots, industrial internet. So connecting, for example, factories with, let's say, edge computing, processing power, connectivity, all of those things, 5G, 6G, edge computing, all of those things, getting connected with those older industries in order to improve those economic benefits or the efficiencies there. And that's where China is heading forward. Interesting investments in this regard would be, for example, Xunlei, XNet, which is building the back end there. Having some projects in this regard regarding chips. I've just mentioned what Huawei is doing. I mentioned before, like Tencent, Baidu, all of them are investing in their own projects there. NIO also is going more vertical, trying to bring out their own chips. There's news, for example, about Black Sesame, which is a NIO Capital investment that has just gotten new approvals and might be a chip being used for sensor data fusion there, maybe with LiDAR, but also vehicle-to-X technology. And some more trends in China would be possibly still around retail. E-commerce is big in China. Also AI pharmacy, for example, Baidu is working in this regard, and the service economy in general, like getting away from the old workbench image and more towards a more upgraded economy in general. So these are the bigger topics, with some of the names that I've just mentioned aligned with that. The differences between the US and China here in this regard as well. I think that would be very interesting to watch. And going forward in 2023, certainly we'll be discussing some opportunities in those areas. And so this is where we are standing. Let me know in the comments whether or not you agree and disagree regarding my sentiment that China has massively de-risked. I think certainly the stock market performance speaks for itself right now. But of course, I know there's always lots of negative takes on China as well, and lots of fear around still. And it will take more time for investors to build more confidence and trust, I would say. But going forward, this should be also at the same time the opportunity aligned with that. So thank you guys for watching. Thanks for sticking around till the end. Make sure to like this and leave a comment. And then thank you guys for watching. See you in the next one.